Welcome to PMS Investments. Have you ever thought about growing your money? Do you want your savings to work harder? Investing is the answer. It might seem complicated, but it doesn't have to be. Mutual funds are a great way to start investing. Think of them like a basket of different stocks or bonds. This spreads out your risk and can lead to better returns. In this guide, we'll break down everything you need to know about mutual funds. Let's get started on your journey to financial success. You can contact us today to know more details. Imagine you want to buy a variety of fruits, but you don't have the time to pick each one individually. You go to the supermarket and buy a pre-made fruit basket. This basket contains a mix of your favorite fruits, all in one convenient package. Mutual funds work similarly. They pool money from many investors and invest in a diversified portfolio of assets, such as stocks or bonds. When you buy a share of a mutual fund, you own a piece of that portfolio. This means you get to participate in the potential growth of all the underlying investments. It's like owning a small slice of a much larger pie. Mutual funds are managed by professional fund managers. These experts make investment decisions on behalf of the fund's investors. Just like there are different types of fruits, there are various types of mutual funds to choose from. Each type has its own investment objectives and risk profile. Let's explore some of the most common types. Equity funds. These funds invest primarily in stocks, which represent ownership in companies. They offer the potential for higher returns but also come with higher risk. Debt funds. These funds invest in fixed income securities, such as bonds. They tend to be less volatile than equity funds but offer lower potential returns. Hybrid funds. As the name suggests, these funds invest in a mix of stocks and bonds. They aim to provide a balance between risk and return. Index funds. These funds track a specific market index, such as the S&P 500. They offer broad market exposure at a low cost. Sector funds. These funds focus on a specific industry or sector, such as technology or healthcare. They can offer higher growth potential, but also come with higher risk. Mutual funds offer a range of benefits for investors of all levels. Let's dive into some key advantages. Diversification. Mutual funds invest in a variety of assets, reducing the impact of any single investment on your overall portfolio. It's like the old saying, don't put all your eggs in one basket. Professional management mutual funds are managed by experienced professionals who make investment decisions on your behalf. This can be especially helpful if you're new to investing or don't have the time to research individual stocks. Economies of scale. Because mutual funds pool money from many investors, they can negotiate lower fees and expenses, benefiting all investors. Liquidity. Mutual funds are highly liquid, meaning you can easily buy or sell shares on any business day. This gives you flexibility and control over your investments. Flexibility. Mutual funds offer a wide range of investment options to suit your individual needs and goals. Whether you're saving for retirement or a down payment on a house, there's a mutual fund out there for you. Section 5. Choosing the right mutual fund for you. With so many mutual funds to choose from, it can be overwhelming to find the right one for you. Here are some factors to consider. Investment goals. What are you saving for? Your investment goals will influence the type of mutual fund that's right for you. For example, if you're saving for retirement in 30 years, you may choose a more aggressive, growth-oriented fund. Risk tolerance. How comfortable are you with the ups and downs of the market? Your risk tolerance will determine the level of risk you're willing to take on in your investments. If you're risk-averse, you may prefer a more conservative fund. Fees and expenses. Mutual funds charge fees for managing your money. These fees can eat into your returns over time, so it's essential to compare fees before investing. Past performance. While past performance is not indicative of future results, it can give you an idea of how a fund has performed in different market conditions. Fund manager's track record. Research the fund manager's experience and track record. Look for managers with a consistent history of outperforming their benchmarks. Section 6. Understanding risk tolerance. Risk tolerance refers to your ability and willingness to withstand fluctuations in the value of your investments. It's an essential factor to consider when choosing investments, including mutual funds. Generally, younger investors with a longer time horizon can tolerate more risk than older investors who are closer to retirement. There are several levels of risk tolerance, ranging from conservative to aggressive. Conservative investors prefer investments with lower volatility and a higher degree of capital preservation. Aggressive investors, on the other hand, are willing to take on more risk for the potential of higher returns. It's crucial to assess your risk tolerance honestly and choose investments that align with your comfort level. Section 7. Determining your investment goals. Your investment goals represent what you aim to achieve with your investments. These goals will vary depending on your individual circumstances, such as your age, income, and financial obligations. Common investment goals include retirement planning. Saving for a comfortable retirement is a primary goal for many investors. Education expenses. Investing for your children's education is another common goal. Down payment on a home. Saving for a down payment on a house is a significant financial goal for many individuals and families. Major purchases. Investing can help you reach your savings goals for large purchases, such as a new car or a dream vacation. Once you've identified your investment goals, you can prioritize them and create a financial plan to achieve them. Your investment plan should outline your investment timeline, risk tolerance, and asset allocation strategy. Section 8. Step-by-step guide to investing in mutual funds. Now that you have a basic understanding of mutual funds and your investment goals, let's walk through the steps of investing in them. First, based on your investment goals, risk tolerance, and research, select a mutual fund that aligns with your needs. Second, ensure you meet the minimum investment requirements for the chosen fund. Next, you can invest in mutual funds online through brokerage accounts or directly through the fund company. Alternatively, you can invest offline through a financial advisor. Then, fill out the necessary application forms, providing your personal and financial information. After that, transfer funds from your bank account to your brokerage or mutual fund account to make the investment. Finally, regularly track the performance of your mutual funds and make adjustments as needed. You can invest online through our link provided in the description. If you are new to investment, you can sign up and log in for your mutual fund investments and monitor your fund performance there. We offer the best service and expert advice. Section 9. Monitoring your investments and making adjustments. Investing is not a set-it-and-forget-it task. It's essential to monitor your investments regularly and make adjustments as needed to stay on track towards your goals. Here are some tips for monitoring your mutual fund investments. First, set aside time each quarter to review your investment portfolio and assess its performance. Second, as your investments grow or decline in value, your asset allocation may drift from your target. Rebalancing involves selling some assets and buying others to maintain your desired asset mix. Third, your investment time horizon is the length of time you plan to hold on to your investments. If your time horizon shortens, you may need to adjust your investments to become more conservative. Lastly, stay up to date on market news and events that could impact your investments. However, avoid making rash decisions based on short-term market fluctuations. Section 10. Common mistakes to avoid. Investing in mutual funds can be a rewarding experience, but it's also crucial to be aware of common mistakes that can hinder your success. Here are some pitfalls to avoid. First, investing without a well-defined plan is like setting sail without a destination in mind. Take the time to establish your investment goals, risk tolerance, and time horizon. Second, past performance is not a guarantee of future results. Avoid investing in a fund solely based on its historical returns. Third, high fees can significantly erode your investment returns over time. Pay close attention to the expense ratios of mutual funds before investing. Fourth, when markets experience downturns, it's natural to feel anxious. However, avoid making emotional decisions and selling your investments in a panic. Lastly, diversification is key to managing risk in your portfolio. Avoid concentrating your investments in a single stock, sector, or asset class. Section 11. Conclusion. Start your investment journey today. Congratulations. You've now completed Mutual Funds 101 and are well on your way to becoming a savvy investor. Remember, investing is a marathon, not a sprint. Start small, stay disciplined, and don't be afraid to ask for help along the way. Mutual funds offer a convenient and accessible way to grow your wealth over time. By understanding the different types of mutual funds, their benefits, and how to choose the right ones for your needs, you can make informed investment decisions that align with your financial goals. Start investing today and watch your money grow.